Hi, I'm Lynn Adams.
I'm Justin Gross.
Welcome to this edition of Video Insight. This is our second quarter conference call for all our clients. I want to take a few minutes to give you an update on the markets, on our portfolios, and just some general ideas about what we see happening in the financial landscape. Keep in mind that nothing on this call is intended to be financial advice or indicative of any future performance. It's just for educational purposes only. So with that, we'll get started. It's probably worth starting with just a look at where we're at year to date, 2019. If you picked up the Wall Street Journal and you looked at the returns at the different asset categories, you think, hey, this is a really good year, right? I think one of the things that it doesn't tell you the story, though, is the reason that you see double digits in different sectors. For example, Russell 2000 is up year to date 14.6%. The S&P 500 is up 13.6%. The real estate sector is up 17%. The international's up 10, emerging markets up 10, bonds are up a little bit. Everything is up, but it doesn't tell you the story that it's essentially the same old reversion to the mean, right? Fourth quarter last year, markets were down a substantial amount. We've put a slide here in the slide deck to sort of illustrate, how this is sort of mapping out. If you look at 2018 for the year, these different sectors that are in there, if you'll notice, for example, emerging markets equities was down 14.2%. The very bottom purple slide there, or chart, speck on the chart, this year is up 10, right? Developed markets were down 13 this year, they're up 10. There tends to be this scenario that when you have larger losses, then when you get a little bit of a recovery, they tend to bounce higher. And of course, the reverse is also true with reversion to the mean. Things that go up a lot tend to go down a lot when you get the next cycle change.
Yeah, the year-to-date numbers are nice, but it's a little bit of a function. I wouldn't call it luck, but just timing. Like to your point, you go back a month prior, these numbers don't look nearly as good when you account for the fourth quarter and especially December.
Right.
I don't know that January versus December really matters to an investor. It's more about the long run, but that 1 month makes a big difference on these numbers.
I do think one thing that's probably noteworthy is that if you look at our portfolios in the last year, and this year it'll probably be the same, I think that this is the first time in quite some time that our returns that our clients have seen or will see are fundamentally different than the market. I think about how many of our clients did not have to endure getting a minus 15% statement in the month of December, right? Like many of the market sectors did from that segment where it was falling. But at the same time, they didn't get their first quarter statements and be like, oh, wow, I'm up 10% again, right? It's the whole process of financial planning and sort of building out strategies that protect on the downside and allow you to participate on the upside. It doesn't always match the market. I think investors are willing to give up a little bit of the upside to get a little bit more consistency in their returns.
Numbers are numbers, but they don't have feelings. Right. But investors have feelings. Right. So if you get to the same point, but you get there in a much different way, how it feels really matters. Right. Because when it feels bad, it can lead to bad decisions. So if you could go way down in December and bounce back, you get to a certain point, or you could just not go down that far and not have to experience that, and maybe not bounce back as hard, but you end at the same place pretty much. And
I'm sure, I know that particularly like, for example, the week around Christmas, there was a lot of selling going on. That's people. That's people responding to, hey, this is really getting bad. I'm going to sell. I can't lose any more money. And then they miss all of the recovery.
And it's a lot of selling without a ton of thought.
Right. So, year-to-date numbers look good, but the point is, it's really just a bounce from where we were back in October, right? So I've got this really interesting slide here. I showed it to Justin. He says, man, just the size of that grass gave him some anxiety. But here's the thing. This slide is this concept of watching grass grow. I feel like this market is really as if you look back, say, 2017 to now, I feel like somebody snuck into my yard in the middle of the night back in 2017 and put down a bunch of fertilizer. And of course, that's kind of like what the tax bill did to stocks, right? And suddenly in 2018, you got things growing all kinds of fast that aren't normal, right? And we got to around the third quarter of 2018, and we had the Federal Reserve pushing rates up, kind of pumping the brakes. We have President Trump, really negotiating hard to try to get a better trade deal. And those are really, in my mind, kind of like somebody coming in with the lawnmower, right? So now you're left with this sort of trimmed down, the next slide, has a much better looking curb appeal, but it's more trimmed down. And I think when you see this fast growth get trimmed down to something that's more healthy and sustainable, a lot of people fear that that's sort of a prequel to something worse, right? And I would argue, and I'm trying to illustrate with our pictures here, that healthy doesn't have to be growing out of control, right? I mean, so I think we're in a healthy environment today. Earnings are doing fine, and things are not overly out of control on the growth front, but that triggers these fears, right? So people are asking the question. Right?
Yeah, and it goes back to psychological again, because if it goes up and the grass is or the market's going up out of control, well, a pullback means that it's down from that point. But as human beings and as investors, we often tag ourselves to that all-time high. You remember the highest that ever touched.
Right.
And anything below that is less than that all-time high. And that's where you're going to be the most of your life as an investor.
Yeah.
So you don't, but a more equilibrium approach, and maybe it was too far too fast, came back a little bit. That's also the nature of markets.
Right. So the big question is, where do stocks go from here? That's the question, right? And we don't know. Anybody that says they know is probably pitching you something that, I wouldn't really listen to in the short term. But here is something that I think I hear a lot of, and it concerns me, is that I hear this term, we're late cycle. We're at the bottom of the ninth inning. We've been in this expansion for so long, and of course that implies that we know what comes next, right? And we believe that we are certainly due for like a recession from a number of years standpoint, since we've really had a recession. But it's a different environment today than it was before the last several recessions that our country's ever seen. And I don't know that the number of years is the guiding element to tell us when the next one would come. I put a couple slides here that just says, hey, the case for no recession, right? Now, I'm not saying that we can't have a recession, because those can be triggered by a lot of different things, but let's look at the things that sometimes cause recessions and look at where we're at today relative to that. So the first slide is the cyclical sector. So if you think about what drives the economy, about 65% of our domestic economy is driven by these cyclical industry groups, right? And when we look at residential investment, when we look at motor vehicle sales and parts consumptions, looking at business investment, which is capital spending, and you look at the changes in inventories in the different retailers, normally prior to a recession, these things have run up to some pretty high levels and created this sort of frothy, bubbly type environment. And we don't really see too much buildup in any of these. We could argue that capital spending has been up a little bit, but it was really down for a while, and then private inventories are up a bit. But even I think we'll see the next report showing that number coming back down. But in order for you to have a real recession, you got to have massive declines in these factors, and I don't think we're going to see that with what's on the radar from an earnings standpoint. And the other thing that people talk about, well, what's also caused recessions in the past, say, well, if the Fed raises rates and pushes interest rates up to too high of a number, we hear that a lot, right? And this next slide here shows us that just because the Fed has raised rates, now we've come all the way up to a very high 2.4% on the Fed funds rate. Think about what the average rate of Fed funds rate was before the last recessions. It was at 7.55%, so we're not even in the same ballpark, right?
Yeah, no, all of these are factors and indicators you could look at, and none of them are screaming it has to happen, nor will they. Recessions don't come with a email reminder to say it's going to happen. You just don't know, and you don't know what's going to cause it. But none of the things that someone would typically look at are out of line.
Right. In fact, most of the time when you see recessions and losses in the stock market, there's a phrase that you only get killed from the train that you didn't see coming, right? We're constantly looking at what could go wrong. The bull markets tend to climb a wall of worry, right? Every day they're looking for something to worry about.
Yeah, I think the whole point, and we are seeing that thrown out a lot, late cycle.
Right.
And I think that's probably more from a time, just a duration standpoint. But you could have argued late cycle economic for the last 5 years. And if
Right.
you made that determination and you tried to time the market, you missed out on some gains. So we're not going to try to time it either way. We're going to react to what we get, and you just don't know.
A couple other things that probably come into play that would lead us to believe that a recession is not imminent. If you look at this slide on inflation, we are in pretty low inflation territory. Headline CPI 1.5%, core CPI around 2%. I mean, these are really low inflation. If you told your parents, or I told my parents, that hey, we're going to be 7, 8, 9, 10 years at inflation at 1 to 2%, they would say, sign me up to live in that world for sure, right? Because I mean, that is way below historical norms, and that is very good for fending off any kind of recession. I guess let's turn the corner here and talk a little bit about, what do we see for economic growth in 2019 and into the future. Now, I've heard people say that this is bad news, but I actually think it's kind of good news. A few weeks ago, the Federal Reserve came out of their meeting and said, we're going to revise GDP estimates down to 2%. And for the last 3 or 4 years, the Federal Reserve has maintained that they had anticipated our economy to grow at 3 or 4 or 5%, right? Well, not necessarily 5, but a few years back. But there's been a disconnect between Wall Street and the investment bankers' belief of what the economy can grow at if it's healthy, and what the Fed has believed it could grow at. And now that the Fed has finally come to the same consensus as Wall Street and as most major economists, that we're probably looking at 2% year-over-year GDP growth, I think because there's not this debate as to where we're going to land, I think that's going to help keep volatility range bound. A lot of times when there's opposing views that, on one side we think it's going to be way over here, on the other it's going to be over here, we fight about it, and whichever belief tends to be in vogue that day, the market reacts to it. The fact that now everybody believes we're going to be on this slow growth, slow train at 2%, I think is going to help keep volatility down.
Yeah, it's like you don't have that tug of war, and whoever screams the loudest today makes the market react. It's
Right.
Much more consistent.
So I think, earnings for this year, corporate earnings look to be in line with pretty much where they were last year, maybe some slight improvements here and there. Keep in mind, for 19 to outdo 18, it'd have to be pretty extraordinary, because 18's calendar year earnings over 17 were up over 20% year over year, right? So it is okay, I think.
Yeah.
Imagine if you run a business, right? You've been running a business your whole life, and 2017 was your best year ever, and then 2018 you were up 20% year over year. If the next year you can do that again and just stay put at that new number, that's a win, and I think that's where we're at in our economy. But it doesn't sound right when the talking heads get on TV and say, well, year over year growth is zero. That can sound bad to the unsophisticated person.
Yeah, decrease doesn't necessarily always mean bad if you've had that banner year
Right.
setting the bar too high.
So with that, we probably think that we'll be sort of range bound this year with the market, because the market will react to earnings forecasts. Earnings forecasts are sort of flat. GDP's slightly positive. I think if you take your dividend yield from the S&P, which is in the mid to high 2s, I think if you take a couple % of actual organic growth, you get a little bit there. Maybe on the bond side of the balance sheet, we're getting almost 4% on certain bond areas now. You take those and blend them together, we're probably going to have a modest year. Not anything great, but I wouldn't think it would be terrible unless we get some dislocations, which obviously are always...
Stand ready for that, though.
Stand ready, because it's always possible. Valuations, they're not necessarily out of control here. Market's selling currently at 16.4 times annual earnings. 25-year average is 16.2. Honestly, when I look at this and I look at valuations and look what's going on, it's kind of like watching grass grow. It's really nothing sexy to it. There's nothing exciting. There it is, and it's a slow process.
If
right?
you don't pound the table, it's right at the 25-year average.
So, what it will probably take to move this market in any noticeable direction will be some headline event, some potentially a natural disaster, or some geopolitical uncertainty. I mean, those things can happen and will happen, and it'll move the pricing of the market when they do, but I just don't see recession being the reason in the near term. Let's turn and talk briefly about international. We've had this recovery in the U.S. for quite some time. It's up over 300% from the lows back in 2008, 2009. Meanwhile, international markets are only up over a little over 100% from their lows. There is a disconnect there. International markets have not rebounded and gotten to new highs to the same degree. It's about a 20% discount for earnings if you're buying stocks of non-U.S. companies relative to U.S. earnings. So I think that there may be some opportunity overseas to pick up some gains there. We actually re-entered international earlier in the month, I want to say around the 15th, and we've taken sort of a neutral position overseas, but we didn't have international for a while last year because things were deteriorating in certain areas. Right. So that's a pretty good opportunity maybe. And then some risks. What will be the thing that will trigger the market to move or get volatile? These are the things that I think could happen. If President Trump comes up empty-handed on the trade deals, I think the market is maybe starting to get a little optimistic that he'll get something done there that's good for America. If that falls apart, we might get some knee-jerk reaction, emotional sell-off, but again, earnings are going to drive the market big picture, so I'm not sure that that will be a long-term problem. I think if the Fed raises rates again, or if the market begins to price in that the Fed is going to raise rates, corporate debt, or the leverage ratio in corporate America, is now about 50%. It's kind of on the high side. There's two ways to make money when the market's not going up fast, right? One way is to leverage, take the little incremental bet and just borrow and borrow and borrow and really double down on that little bet. And I think corporate America has done that. But if you get increases in interest rates, that can cause them to deleverage quickly, right?
Agitate that. Yeah.
So it might pull back if we get that going. I think there's a risk on an individual investor level that I think is kind of becoming a problem. A lot of people I talk to aren't asking about, well, how much could I lose if fill in the blank. I almost feel like such a long amount of time has passed since we've had a real market recession, that people are not thinking about what that looks like. What will a -30 or -40 or -50 like the last couple of recessions did? And I just think everybody needs to stay alert. That's what a recession will do when it comes next time. And I don't think people are. I had somebody tell me the other day, oh man, 2018 was terrible. And I'm thinking we were down like 4, right? What if it was 10 times that bad, right? Because that's what terrible is in the stock world.
We're speaking the other day, and December was kind of the preview.
Right.
And maybe a lot of our portfolios were protected from December, so maybe you didn't realize it. But if you just look at market returns, 15% in 2 or 3 weeks, and it can happen fast, and people get scared quicker than they get confident. So selling can happen quickly. Right. And like I said, you're not going to get an email or a notice of here's why it's coming.
Right.
But you got to stand ready. And I think from a risk management standpoint, you have to protect against the thing that kills you.
Right. Well, you have to have
the same
a plan.
thing with any insurance.
You have to have a plan.
You don't insure against everything.
Right.
But you protect against that -30, 40. I mean, that could derail some plans.
Yeah.
So
as long as everybody's got a plan, we feel like we've got good plans there, but not everybody does. And I think that's the takeaway there is that's a risk, is just not having a plan when we do get into the next recessionary environment, whenever it may be. Some conclusions from here is I do think this is a cycle where it's going to be much like watching grass grow. It's 2%. I mean, 2% growth is a pretty low number. So you're not going to feel like you're going anywhere fast. So to get growth, you'd have to leverage on it if you really want to try to get more, or you could bet on some technology disruptors. The problem is if you bet on the disruptors and you pick the wrong disruptor and it doesn't work, then you've lost. It
could disrupt you.
It could disrupt you, right? Anything that you can, make a killing on can also sort of kill you if it doesn't work. So we don't tend to do a lot of that. But those are really the only way I see to get sort of strong growth right here, unless we do get a big pullback when we buy in cheap. And then just be prepared for sort of a period of time of kind of range-bound returns. Our population isn't growing. We're trying to seal off the borders, if you will. I mean, not necessarily figuratively, well, maybe figuratively. I'm not sure how that's going to work out. But we don't have a really loose immigration policy anymore, so we can't let a lot of people come in the country and ramp up the quantity of workers. So with a very low number of new workers entering the workforce and a lot of people still retiring, it's not going to be a robust period of time here for the next few years. So Slow and steady wins the race.
Yeah, I think one thing we didn't particularly spend a lot of time on, though, is with the rise in interest rates and the short end of the curve, our conservative investors, there are opportunities now. You can go out and get, for what feels like the first time in a really long time, to get 3 or 4, 5% if you want to take a little bit of risk in some dividend paying, but just fixed income opportunities. And for a long time, you've been used to those rates being zero-ish.
Right.
So that's more for the conservative, not necessarily the growth investor, but
no, that's definitely worth a good thing to point out. I do think the more conservative clients will be happier with the more regular yield. You know,
versus having to stretch because of zero.
Right. Well, anyway, that's about all the time we've got for today. Hope you found some use for this message. If you didn't get the slides, we'll get them to you. If you have questions, email us. We appreciate the opportunity to serve you and your families. And we're here if you need us. And with that, we will run through the disclosures.
Keep in mind that while diversification may help reduce volatility and risk, it does not guarantee future performance.
The views are those of Adams Financial Partners and should not be construed as investment advice. All information is believed to be from reliable sources. However, we make no representation as to completeness or accuracy. All economic and performance information is historical and not indicative of future results. Please consult your financial advisor for more information.